comfortable today.
The conference is now being recorded.
Can I call the order of the meeting? As I said, please raise your hand and ask your question into the mic and then later email. So, Governor sir.
Okay, good morning. This was probably the most widely anticipated statement. Reserve Bank held rates today. Going forward, we will follow developments on commodity prices, especially food and oil, even while tracking inflationary expectations and external developments. Of course, the implementation of the pay commission proposals and its effects on wages and rents will also be a factor as we consider policy in the future. However, we believe its effect on aggregate demand will be offset by appropriate budgetary tightening as the government stays on its fiscal consolidation path. Now, we are focusing on transmission. Thus far, we haven't seen, we've seen barely half the interest rate cuts since January pass through. We're working with the banks on a new methodology to determine the base rate. It'll be based on marginal costs, and it should be put out sometime this week. We're also, the government is considering the small savings rates and tying them more to market interest rates. And I think both these actions will help transmission. Also, banks are currently engaged in a process of cleaning up their balance sheets, and as they clean them up, they will have more room for fresh lending. We will use the space for further accommodation when available, while keeping the economy anchored to the projected disinflation path that should take inflation down to 5% by March 2017. So that's broadly the gist of the policy statement, and I'd be happy to take questions.
Nisha.
Nisha Podar from ET Now. Governor, you've paid a lot of emphasis on vigilance on CPI inflation. And you have, if I'm not reading it incorrectly, you've been tentative about accommodation in future because you have specially mentioned accommodation when available. I just wanted to understand your future stance, because it has been a status quo this time around, on whether it will depend a lot more on transmission, CPI, which you have said will plateau out, and also, are we already prepared to deal with an imminent Fed liftoff, which is going to happen? So are we going to wait till February for any more measures to be taken, or after a liftoff really happens, there could be something anticipated earlier because our economy needs it?
Okay. First, we are still accommodative. I think that is very clear. We're always vigilant, so this is not anything new. We are vigilant. There are obviously both upside and downside risks to consumer price inflation. We've highlighted some of the sources of risks going forward. One could imagine that there could be downside risks from, say, commodity prices, especially oil. But of course, given where oil is produced, there are also potentially upside risks if there are political events that constrain the supply of oil. So vigilance is always needed. Now, as far as you ask questions about when the next rate movement, etc., what we've said is, when times are warranted, we are always prepared to move off cycle. But when times normalize, we prefer staying with the policy cycle rather than move off cycle. Of course, when we use the words external developments, one of them is what happens to the Fed policy rate hike. Our sense, however, is that's probably even more widely anticipated than our statement today. Now, of course, there are some residual uncertainties about what the Fed will do. But my sense is, as I've said before, after an initial bout of volatility, we probably should see Indian markets stabilize and come through. So it's not, as I've said before again, the central factor in our deliberations going forward. Would you like to add anything? What's that?
Tentative on accommodation going forward, because you
I
used the
think
word
the-
when
I think I've said it clearly. I'll say it once again. We are in an accommodative stance.
I think the way to put this is that, because we don't reduce interest rates, it doesn't mean we are not accommodative. And I think the language in the draft, in the policy statement, suggests that if and when space opens up, we will do what is required to ensure that both the inflation objectives as well as promoting growth on a durable basis will be facilitated by the RBI.
That was Dr. Patel, Deputy Governor, for those who are listening in. Lata?
Actually, the statement says when, but you now said if and when space for accommodation opens. I just want to know if that means something more.
One of the dangers of doing nothing is then you start parsing every word. I think the statement reflects a fair amount of deliberation, and so that represents our stance.
No, that wasn't my initial prepared question.
Okay, so this is question 2.
Okay, no, not at all. Well, actually, the previous policy said that RBI will look at the 1-year forward T-bill rate and subtract from it the 1-year forward inflation, and you want that real rate to be, between 1.5 and 2. Now, today the 364-day T-bill, the 1-year forward rate is at 7.2, and your 1-year forward going by the fan chart is 5%. So actually, we are at 2.2 in terms of a real rate. Looks like you have passed up space to be accommodation. I wanted your comment, but if it is that you are looking at the 7th Pay Commission, I wanted to know whether you would only look at the 3.5% fiscal deficit number, or you would also ponder on the quality of fiscal consolidation. At any rate, what is the RBI's assessment of the impact of the 7th Pay Commission on inflation, both rent and wages?
Right. First, as far as those differentials go, we're not looking at it on a day-to-day basis. It's a rough indicator of what our where we would like to be. As far as the fiscal deficit goes, clearly both the quantum as well as the quality matters, and that is an issue which the government is fully seized of. I'm hopeful that while maintaining the fiscal consolidation path, the government can also maintain the quality or enhance the quality of the budget. So it is clearly an issue that they and us will both be looking at.
The impact of the 7th Pay Commission on inflation, what's the RBI's assessment?
Well, so let me also ask Gurjit to chip in, but in the broad sense, I mean, yes, there's going to be additional expenditure, but there will also, it will be offset presumably by either additional revenue raising or cuts elsewhere so that the fiscal consolidation path is maintained. So in that sense, we don't feel there will be a significant effect on aggregate demand, provided, of course, you maintain the fiscal path. Of course, investment in some ways may be higher quality than certain kinds of spending, and therefore one would hope that you would uncover space elsewhere for the public investment which we really need. And I think the government has taken a number of these into account while anticipating the consequences of the pay commission. So let us wait and see what happens. Ojit, would you like to add?
No, just to say that in the medium-term fiscal policy of the government, some of this was already anticipated. So it's the baseline has some of this already baked in. One impact that will be felt through the CPI index would be via the house rental allowance. But that's a one-time level change, and unless there are wider externalities, we will most likely look through that. But you will feel it in the index through the housing subcomponent of the CPI combined index, because they do sample a fair bit of government housing in the sampling frame that is used, and that impact will be felt from April onwards for 6 to 8 months, and you will see an index change there, but that is likely to be looked through by the RBI. Thank you.
Vishwanathan?
Thank you. So I want to understand what is RBI's assessment about the current growth scenario. The latest GDP figures come at 7.4, but as we have seen, some of the key indicators do not really correlate with these kind of high numbers. For instance, corporate trust, earnings, bank credit growth, auto sales also haven't picked up that well. So do you believe that the growth has taken firm hold in the economy, or still there is a large disconnect between the GDP and the other indicators?
No, I think it's very clear that we are in the process of a recovery. We're in the midst of a recovery. Now, there are areas of weakness. There are places, of course, where you would, agriculture, for example. Agriculture is growing relatively weakly because of the monsoons. Allied activities, dairy, etc., growing more strongly. But as a result, rural demand is somewhat weak, and you see non-durable consumption, for example, relatively weak. Set against that, capital goods has grown fairly strongly. Public investment seems to be growing quite strongly. So I think what we have is an economy which is well and truly in recovery, but with areas of weakness. And hopefully, as we go forward, some of the areas of weakness will turn around. For example, with the kind of investment that is contemplated, construction may start picking up more strongly, and that will be very helpful. Perhaps with the kinds of measures that the government is taking, as well as, for example, on low-income housing, the capital requirement measures that the RBI has announced will have some boost to housing.
So many. Bijoy?
So Bijoy from Cogensis here. First of all, because you mentioned the marginal cost of funding linked base rate, do you think banks are ready to handle ALM management? There's no liquid OIS market at this point of time. Plus, there will be a direct impact on NIMs at that point of time. Do you think Indian banks are ready for that? The other question is slightly old in that sense, because for the last 4 years, savings bank deposit rates have been deregulated, but there has been, somehow all the banks seem to have figured out that 4% is the best rate to have. Clearly, that cannot be a coincidence. So, at any point of time, has the RBI wondered about why the banks are doing this, and has there been any conversation with the banks on that? Also, on ARCs, you said that there was some
There are
discussion.
3 questions there.
Yeah.
Okay.
On ARCs, you said that there was some discussion happening on change in promoter norms for ARCs to enable international players to also come and take a stake in them.
Yep.
Thank you.
The first question was on the marginal cost pricing. Yes, as they move towards marginal cost and eventually a market benchmark, both of which will be enabled, they will have to pay more attention to asset liability management. Clearly, they have the capabilities. The question you asked is, are there the instruments? But, demand creates a supply. When there's no demand, there's obviously no supply. There obviously, as they start looking for these kinds of instruments, others will start creating them. So I have no doubt that the markets will become more vibrant as a result of what the banks will need to do to manage the assets and liabilities mismatches. As far as the second question goes, you asked, savings rates at 4%. I don't want to, conjecture why they've been stuck at that rate for so long. Of course, as you know, perfect competition will also get you the constant rate across the system. I'm not saying there is perfect competition, but we have to, I mean, it is something that perhaps in the future we could also look at, but I don't think we should presume, which you seem to be hinting at, that there's some misbehavior right off the bat, but it is something that we can look at. As far as ARCs go, we're very open to entities who want to set up as ARCs. There's a process of licensing. They have to apply. But if entities want to put more capital to existing ARCs, get licenses to become new ARCs, we are very open to it. And especially, I mean, if there are foreign entities that want to bring in more capital into this business, it's most welcome.
Anupriya?
Thank you, Alpana. Good morning, Dr. Rajan. Anupriya Nair from Bloomberg Television. I want to focus on inflation, and especially services inflation, because that sort of gets neglected out of the headline that most talk about. You've raised the concern on service inflation time and again. Even now, when you look at the non-food side, the real pressures you mentioned as well coming in from education and healthcare. As the GST probably will get implemented, deadline or not, what's the upward pressure on inflation that you see from that implementation as well, sir? And secondly, we've all talked about the Fed liftoff and the impact, but rather the consequences of the volatility from an excessive QE from the ECB side, likely another 48 hours, and then an inevitable Fed hike as well. How do those cross currents work out for India, especially in the currency market, which has already seen a bit of a pressure? And I'm going to sneak one more in. Bijoy talked about ARC. Are there any relook on ARC sale norms? Because we have seen sales to ARCs done at pricing which have raised eyebrows in the past quarter. People have also questioned on 525 norms having to be tightened a bit so that the can is not kicked down the road to a new generation. Any relook on that, sir? Thank you.
First, as far as services inflation goes, and I can see Alpana looking at you very crossly. Please don't ask 3 questions for one. Services inflation, how many am I allowed to answer? One, sir. Only one? Okay. Let me pick the easy one. Services inflation is obviously a source of concern. I think it largely reflects the supply constraints in our economy, that high quality education, high quality healthcare, or reasonable quality healthcare and reasonable quality education are relatively in short supply, which is why you see higher inflation there. And that's one reason why we keep saying this is not just about food, it's about other elements. Now that has been coming down over the last year or so. But obviously it gets impacted by things like taxes. Now, as far as taxes go, that's not wage or price push inflation, and we'll have to figure out a way if, as and when GST comes in, for example, and there's a big change, how we account for that going forward. So it is something that we will have to adjust for. As far as the second question was currency, dollar and ECB moving in opposite directions, it does create problems for countries like ours, because partly people are not aware of the concept of real effective or nominal effective exchange rate. The one exchange rate that always matters is the dollar rupee. So at the same time as they're saying dollar rupee weakest in the in the history of the rupee, turns out that we're pretty strong because we've appreciated versus the euro, versus the yen, versus many Asian currencies. So it does make the dialogue a little more difficult, though. The other aspect is, of course, there are these volatile flows, because you may see outflows from the euro area, but flows back into the dollar area. We'll have to manage it. Unfortunately, this is how the global monetary system is, and we have to live with the way it is. My hope is down the line the euro area also strengthens enough that the euro area contemplates a monetary normalization. The third question was ARCs and the price at which assets are sold to ARCs. Well, the truth is this is a problem around the world. Banks are reluctant to sell at the prices that companies that deal with distress are willing to buy. And so there's always a wedge between them. At some point, they both come to an agreement and assets are sold. Typically, these assets are sold at prices that are lower than what the banks would like to have. Now, we are in dialogue with the banks on a number of issues, including the assets on their balance sheet. And we are talking to them about what is being done on the 525, et cetera, et cetera. We have given a number of facilities to the banks to improve their asset quality. We are very concerned, and we insist that they be used in the right way. And hopefully, going forward, these additional powers, as well as the additional recognition that banks will now be doing, will clean up the balance sheets in a significant way so that banks will be in a position to grow and lend going forward. That is something that we are fully engaged in right now, and we hope that the outcomes will be visible in the next year or so.
Shobna.
Yeah, Shobna from Financial Express. So Piyush Goyal has put out the SEB restructuring plan, Uday. So, going by that now, once the loans are converted into bonds, he's talking about roughly an 8% interest rate, whereas the current loan rate is about 12%, 12.5%, 13%. So that's an immediate hit for the banks if they subscribe to the bonds. So how does the RBI see that? Because, these are very large quantums of loans. We're talking 30,000, 40,000, 50,000, lakhs of crores could be converted. And if they don't buy the bonds, then are they writing off the loans, or are they going to be subscribing to the bonds? So
this is all still being discussed.
I think final plan that the government has put out.
The banks will take a view on what they're supposed to do with their loans, right? Ultimately, the loan is from the bank to the DISCOM. The banks don't have to buy the bonds. The bonds can be used to repay the loans, but the banks don't have to buy the bonds, okay? Now, what we have to see is what the final sort of structure emerges. This is still, I think, the I's are being dotted and the T's are being crossed.
Who do you envisage is going to buy the bonds if not the banks?
Well, let us see. I mean, banks have their boards. They have to make decisions, and they will have to make decisions based on their capacity.
Is RBI advising them, quote unquote, on this in any way?
As I said, this is still being discussed.
Two questions in Hindi, Pradeep and Amol.
सर पहला सवाल मेरा यह है, आपके आखिरी पैराग्राफ में आपने कहा है कि सरकार स्मॉल सेविंग रेट्स को मार्केट लिंक बनाने पर विचार कर रही है. क्या आरबीआई के साथ कोई बातचीत हुई है? किस तरह से ये मार्केट लिंक्ड हो सकता है? क्या बेंचमार्क हो सकते हैं? क्या कोई सुझाव आपने, कुछ सजेशंस दिए हैं हाउ टू लिंक इट? और
सजेशंस तो हमने दिए हैं. लेट अस सी व्हाट द गवर्नमेंट कम्स आउट विद.
Okay. Or
would you like to say something?
We have government had asked for data and all that we have given, and the suggestions will vary whether it can be reset quarterly or half yearly or annually. We will like to be reset as frequently as possible. Then they have to collect data and all that. And what is the benchmark? There is already benchmark suggested by Samala Gopinath committee, G6. So how much spread they will allow and what frequency they will do. The discussions are going on. And the government is working on that.
Okay. मेरा दूसरा सवाल यह है कि कल ही आईएमएफ ने जो फैसला किया है कि वो चाइनीज़ युआन को इंटरनेशनल बास्केट में शामिल कर रहे हैं. रुपए पे भी काफ़ी डेवलपमेंट्स हुए हैं, जो रुपी बॉन्ड्स इशू हुए हैं हाल में, और कल आपने जो गाइडलाइंस जारी किए ईसीबीज़ के, वहाँ भी रुपी बॉन्ड्स के लिए अलग से प्रोविजंस किया है. लेकिन रुपए के इंटरनेशनलाइजेशन के नज़रिए से आपके समझ से हम चाइना से कितना पीछे हैं?
See, how far are we behind China? On some dimensions, we are ahead of China. I think in terms of the degree of competitiveness within the banking system, some of the markets, we have made some steps which are, we have taken some steps which put us ahead. But in terms of size of the economy, in terms of the extent of external trade, in terms of denominating trade in renminbi, I think they're much ahead of us. So my sense is this is a process. We are taking steps. We are steadily moving towards being a much more open economy while keeping some of the concerns about stability, making sure that we have things broadly under control, keeping that in mind also. So we are taking steps. As you can see, the steps are regular. They're all in one direction. The announcement, for example, of FPI limits now is over a medium term. The ECB policy announced yesterday. The masala bond, as they say, which number of companies are thinking of issuing. All these are in a direction to broaden and open up a little more. But at the same time, it's not a big bang where we lose control over the whole process. It's a steady process.
Malika, can we check if there are questions outside?
Certainly. Ladies and gentlemen, in the audio conference, if you wish to ask a question, you may press star and 1 on your touchtone telephone. We have the first question from the line of Radhika Mervin from Business Line. Please go ahead.
Hi, good afternoon, sir. I just had one question. With regard to the transmission that we have been mentioning, in the past, the transmission has happened only partially. In fact, it's been less than 40 or 50% of the rate action by the RBI. So considering that, banks have repriced 50 to 60% of what they can in terms of deposits, where do we expect the additional transmission to come from? Is it only because the banks will move to, the marginal cost of funds? Or as we've been discussing earlier, of, talking about a market-linked benchmark, which will kind of help every other segment to follow that particular yield curve, and hence there'll be a transmission across, different products.
Yeah, I think that if you look at, say, 1 to 3 year deposits, banks have already cut significantly more than has been transmitted through the base rate. So in that sense, there is room building up for the banks to transmit more. I think it's a matter of time as these costs flow through. What the marginal cost pricing does is make the costs flow through into lending rates faster. So the intent is that at least for a time, banks will have, will be able to make loans, incremental loans on the marginal cost pricing, while their historical or their legacy loans will be on the base rate. That is the intent as we go forward.
Thanks, Malika. Amol?
यस सर, मैं सवाल मेरा ट्रांसमिशन को लेके ही था कि आपने बार बार ट्रांसमिशन का जिक्र किया हुआ है और जो स्मॉल सेविंग इंटरेस्ट रेट्स, मार्केट इंटरेस्ट रेट की भी बात की है और बैलेंस शीट की भी आप बात कर रहे हो कि बैंकों के बैलेंस शीट क्लीन करने की ज़रूरत है। तो सबसे पहले मैं ये जानना चाहूँगा कि 125 बेसिस पॉइंट कम होने के बावजूद भी बैंकों का लेस देन काफ़ी कम हुआ है रेट, लेकिन उतना भी नहीं हुआ कि जितना होना चाहिए था। तो उसके लिए आप क्या करना चाहते हैं आगे? और जो बैंकों की बैलेंस शीट बार बार कम क्लीन करने की आप बात कर रहे हैं, एग्जैक्टली क्या प्रॉब्लम है वहाँ पे? और ये क्या सिर्फ पीएसयू बैंकों के साथ है या फिर प्राइवेट बैंकों के साथ है जो आप क्लीनिंग की बात कर रहे हो? कौन से ऐसे एस्पेक्ट्स है जो आपको लगता है कि ज़रूरी है उनको क्लीन करना? एंड सेकेंड सर, 7th पे कमीशन की काफ़ी बात हो रही है, हालांकि कंजम्पशन बढ़ जाएगा, लेकिन इन्फ्लेशन जो आपका 2016 तक 6% और 2017 तक 5% का टारगेट है, क्या उसमें बाय एनी चांस हिट करेगा ये?
Now you got 3 questions again. Huh?
One per person.
So I think I've already answered the transmission question in twice. So let me skip the transmission question. On the question of bad loans, I think our approach to this has been very systematic. The first part of the process was to give bank more powers and more flexibility to deal with it. And the idea is to put the real asset back on track with whatever needs to be done. Okay, so that was the first step with things like the SDR, with the 525, with the bringing in new promoters and so on. A whole range of steps have been taken there. Now, given that banks have more powers, we can now be a little more careful about recognition. And the first step of that was to do away with the forbearance starting April 1st. But the next step is to make sure that what should be classified as A is classified as A and not B. And there we're in constant dialogue with the banks and also looking at how some of these existing facilities are being used to make sure, as somebody said, we're not kicking the can down the road. So this process is ongoing, and my hope is as the banks recognize more of what needs to be recognized, and they deal with the stressed assets. Remember, stressed assets, NPAs plus restructured, is a important part of bank balance sheets. That they will be able to bring that down, and not just by provisioning, but also by putting some of these assets back on track, so that they can be elevated back to performing assets over time. So this is what is underway, and it's both for public sector banks and private sector banks, but as you well know, more of the problem is in public sector banks because they went more into infrastructure investment, where many of the difficulties lie. Okay, so this is underway, and we hope that over the span of the next year, I want to put something like March 2017 on the table as when we hope that a full cleanup will have been done.
Govardhan?
Govardhan from the Economic Times. Sir, this inflation forecast, so next year probably you will have this base effect of the low commodity prices go away, and at the same time, last time the inflation cycle was mostly because of NREGA as well as this pay commission implementation. Is it going to be different this time if you have assumed the kind of a forecast that you have already given?
See, throughout the year there are base effects because it depends on what happened the last year when inflation picked up and when it went down. So if you look at a chart, you will see base effects starting to show up towards the middle of next year. And in a sense, they also reflect seasonalities in vegetable prices, in pulse prices, and so on. Broadly, what one should be looking at is the momentum of inflation over time to see that that is well contained. We've already talked about a number of factors that go into that momentum. Let us see. Our sense, which is why we cut interest rates last time, was that the balance of risks, how much we wanted to do for energizing growth versus how much we had to be worried about inflation, allowed us to reach the policy stance that we did last time, which we've maintained this time. Now, going forward, if room opens up, we will be able to do more, as we have said.
On a base rate, like in the sense, you had said that the markets have been more efficient in transmission through the CP rates. But you have been talking about the base rate also, and you had said that banks would be forced to follow the markets and lower the rates.
Yes.
So then, why is RBI so bothered about the base rate and keep whipping the banks to lower the rates?
Well, that's a good question. I was confusing your base rate question with base effects. Base effects in inflation was what I was talking about. Yes, that there will be competition, but the base rate, there's a particular way to calculate it. And our worry is that that should not come in the way of banks passing through lower lending rates to customers. So that is why we took a relook at the base rate, and that is why we're coming to this marginal cost pricing, which we will announce later this week. That will give the banks the flexibility to move more quickly, while the base rate would not allow them to move if they followed the average cost, would not allow them to move quickly. Okay, the marginal cost will allow them to move much more quickly and react to the kind of competition that you talked about from the markets. Today, for example, the newspapers are reporting a significant increase in commercial paper issuances, which essentially means corporations are going there rather than going to the banks. So at some point, when the banks want to recapture that market, the way they calculate their lending rate should not stand in the way of their competing. That's why this is important. Well, the base rate forms the basis for your EMIs, right? So you can't scrap it. What is then going to take its place? There has to be something. Ideally, we would have a market-based measure which is sound, which is credible. LIBOR used to do it in the West, but LIBOR has come under some cloud recently. We need a market-based benchmark which doesn't have those kinds of problems. We are in the process of creating one. There is a company which is collecting those rates. As we get some experience, we will get a market-based benchmark. But till then, we need some way of calculating, and because people rely on this, they have to have a sense of how this is going to move. Contracts are written on this basis. That's why we need to actually regulate this.
Last two questions, Aparna and Anup.
This is Aparna from the Mint newspaper. Sir, I have two questions. My first question is on small finance banks regarding the foreign shareholding. A lot of these players already have very high foreign shareholding. Some have 75, 80%.
Which one?
Small finance banks. A lot of players already. So what they say is that the RBI needs to give enough time to comply to the norms that you have set out for. So is there a rethink that the timing to meet these norms could be extended, or you feel there is a need for that? And my second question is, you said in September that transmission has taken place very quickly in the bond markets and the money markets. You mentioned CP rates, which are still benign today. But the 10-year benchmark yield, which is the sovereign curve, that has hardened a lot. So whatever we say, that is the poster boy of the yield curve, and a lot of people consider it as a proxy for pricing. So you think that you need to change probably the stance of the liquidity stance of the RBI in order to help the bond market in terms of the...
See, we don't determine liquidity to help the bond market. It's an incidental effect. I mean, it'd be good if the bond market is helped, but we primarily provide liquidity because the system needs liquidity. A good measure of whether there's enough liquidity in the system is how much various entities are borrowing from the various windows. And they haven't been borrowing an excessive amount, which suggests that there's plenty of liquidity. And if you look at short-term rates, they're pretty close to our policy rate. So we are providing the liquidity that the market needs. And I think it's fairly well balanced there. Now you're asking, should we be directly targeting the bond yield through some kind of a quantitative easing measure? I think we are in a very different situation from other industrial countries. Now, what is driving the government bond rate, the 10-year rate? Clearly a variety of factors, including the sort of tightening that's going on or the anticipated tightening that is likely to go on in industrial countries, that you see some co-movement between the 10-year treasury rate, the US Treasury rate, as well as government bond rates in a number of emerging markets. So that's part of what is going on. So there is also, there was some supply that came onto the market from the government in October. That is easing off now, but it is another factor that comes into the determination of long-term yields. So the point is, long-term yields are a complicated phenomenon where many factors intrude, not just monetary policy. And so it's something that hopefully over time will stabilize and come down as anticipation of lower inflation, as well as are reaching our inflation target over time. As that sets in, these yields should come down. Urjit, would you like to say anything?
No, just that short-term fluctuations in long-term rates are difficult to attribute to any single source or driver. And if at the margin our bond markets are open to the outside world, then we are likely to be affected by that a fair bit. And if you look at the covered parity calculations, we are more or less in line, taking away issues of risk premia and term premia.
On the small finance banks, they have 18 months. So I think that's a fair amount of time to do what they need to do in terms of raising or altering their capital holdings. So it is a fair amount of time.
Sir, this is Anup Roy from Business Standard. You mentioned that your Obika survey is seeing some robust growth in manufacturing and some in pockets of development, pockets in the economy. How much credit goes to the Reserve Bank of India's policy cut? Because obviously when the economy was not doing good, you were criticized for not cutting rates. One, and since I'm the last person, I'll ask one more question. More than this Fed and Europe's quantitative easing, it looks like China's devaluation or adjustment of its currency peg affects Indian rupee more. So do you think it's a good way to let the rupee depreciate when China devalues to maintain India's competitiveness?
Okay. The first question is about news on manufacturing. Again, this is early. When we use the word early there because it's based on a small sample in our Obika survey. It's not the entire sample. But nevertheless, I think what causes growth. It's actually a whole mix of factors. So I would be far from claiming credit for monetary policy. Lots of other factors, including the feel-good factor introduced by the government, the public investment, lots of other things go into this. So I think it's not a useful question to answer that how much are we responsible. I have no idea.
But sir, you were being criticized when the growth doesn't take place. People say that RBI is not cutting rates.
Yeah, but that doesn't mean I should take credit when the growth takes place. Look, we're all working together to ensure that growth takes place. I think it's in our collective interest. And I kept emphasizing, I will emphasize again, the RBI is not against growth. We need sustainable growth. We will ensure there is sustainable growth, and we'll ensure the maximum sustainable growth we can get. Now, sustainable means within the bounds of whatever inflation we are willing to accept. And that's what the government sets for us. This is what inflation we're willing to accept. And what our job is to create the maximum growth consistent with that. Now, remind me, your second question was?
So this is about China's currency peg adjustment and whether Indian rupee...
the Chinese devalued initially but then stopped and in fact it came up a little since then. And perhaps with the Chinese inclusion in the SDR basket, you may see a little more of that. But we don't sort of, see the exchange rate as something that we can manipulate in a significant way to attain whatever macro objectives we have. We've said repeatedly that our intent is to minimize volatility in the exchange rate rather than target a particular level. Now, the market, as it moves the exchange rate, determines what is reasonable given the various market forces that are underway. As I said, if you look at our exchange rate, over the course of this year, the nominal effective exchange rate is approximately flat.
Thank you.
Well, that's it for today. Unless...
the one last question is always the most dangerous question. Let's do one more, but somebody who hasn't asked, right? Alpana?
Manojit Shah from The Hindu, and I will ask just one question. You have said this March 2017 target, the banks will be able to clean up the balance sheets. How crucial the reforms, the banking sector reforms, to attain those targets? Are you happy with the pace of banking sector reforms? Vijay Nayak submitted his report about 15 months back. There are some sporadic things, but the pace of banking sector reforms, public sector banks, are you happy? How satisfied are you with that?
A number of actions have taken place, including splitting the chairman and the CEO of the banks, appointing some private sector players as CEOs. There's a process of appointing new bank board members, typically more professional. The bank board bureau is being set up. So a number of actions have taken place. My sense is these have all been, quite positive, and of course these things play out over time. But let us see how it moves.
Is it crucial for this 2017 target? How crucial?
It's absolutely crucial because I think if you take the broader process that we are trying to do together with the government, first, change the governance process of the banks, move towards cleaning up the bank balance sheets and appropriate recapitalization, and then they will be in a position to do the kind of lending that the economy will need as the recovery picks up stream. So that's the process that is being followed, and I think it's well underway.
So that's finally it. Thank you very much. Thank you, sir. Thank you, Malika.
Thank you very much. Ladies and gentlemen, this concludes the conference call. Thanks for joining us.
Would you answer?